Welcome back. I'm Kirill Talai, investment analyst with a decade of experience. Here we connect the dots between macro, crypto, and AI. No noise, just what actually matters for your portfolio. Two stories this week. The first one is the update on the Iran situation. It looks like the conflict is closer to resolution, although some risk remains. We will see if it's too late to enter the market. The second one is bigger. I want to talk about how I see the rest of 2026. I think there's one variable that drives most of what happens between today and the midterm. We will talk about it and how I see risk assets performing into the year end. Quick disclaimer, nothing on this channel is financial advice. I'm sharing my views and analysis, but you always do your own research.
This video was created in collaboration with the IT company Anderson.
Okay, let's start with Iran. The big diplomatic move happened on the weekend of May 23rd. Trump posted on Truth Social that a deal with Iran, including the reopening of the Strait of Hormuz, has been, in his words, largely negotiated. The framework that has been floated and reported through multiple channels has these features. A 60-day ceasefire extension, the Strait of Hormuz reopens with no tolls, Iran clears the mines it deployed in the strait, the US lifts its blockade on Iranian ports and issues sanctions waivers so that Iran can sell oil freely, Iran commits never to pursue nuclear weapons, and the nuclear question itself, the uranium enrichment program, gets separated out and pushed into a 2-month negotiation track. However, by Sunday, Trump himself was already walking it back, saying the deal was going to take a bit more time. Rubio said on Tuesday that the formalization of the agreement still needs a few more days, so the deal can still slip. I think the headlines are going to whip back and forth between optimism and pessimism, possibly for a week or two. The cross pressure on Trump is real. The way I see it is that the Israeli side and Republican hawks are pushing for a restart of the war and arguing against a deal that is too lenient. The Gulf states and the Arab partner countries are pushing the other way and urging Trump not to bomb Iran again. The domestic electorate does not like Trump's policies and is very angry about high gas prices. So, whenever Trump publicly accepts something close to the Iranian proposal, the Republican base and Israel push back hard, and he pulls back to extract slightly better terms. That is the choreography. That is how these things move, in my opinion. So, bottom line, we need to wait a bit more. The takeaway here is the same one we have had since the conflict started. Any volatility related to the conflict, especially to the back and forth headlines, is a buying opportunity, not a moment to de-risk. The trajectory is toward resolution. The path is not linear. So when the next headline says the deal is off, that is the moment to end, not the moment to sell. So bottom line, I'm sticking with the same view. You need to add exposure. Here's the other piece. Even if the deal slips and we get another 6 or 8 weeks of headlines back and forth, the oil market is more balanced than not. Multiple flows are doing the work. The first one is China. The Chinese buyer's strike is real. China is importing roughly 6 million barrels per day below its normal pace. Part of that is the use of strategic petroleum reserves. The second one is the United States. US crude exports are running at an extraordinary pace, with ongoing releases from the strategic petroleum reserve adding to the supply in the background. Put those two together with the Saudi measures of diverting oil exports to the pipeline that bypasses Hormuz, and the Russian oil sold to India under the US Treasury waiver, and you get roughly 15 million barrels per day of offset against roughly 20 million barrels per day Hormuz disruption. That is enough to give the global oil market 7 to 8 weeks of balanced flows, with oil at $90 to $100 per barrel, even with no Hormuz deal. Some of these solutions are permanent fixtures, others have expiration dates, but in the near term, they appear sufficient. Also, the prices of fertilizers, helium, and other commodities flowing through the strait have been on a downward trajectory since their peak in April. So, the calendar that matters here is the next months or two. One thing worth understanding here: the market is at all-time highs, but the rally itself has been hesitant. The standard advisor surveys, investor intelligence, and AA Bull Bear show bullish positioning below the 2024 and 2025 averages. Breadth is weak. The percentage of bulls is sitting at the low end of the recent range, not at the upper end. There is no euphoria here. That matters because it means a resolution in Iran does not have to fight crowded positioning yet. If anything, the resolution forces a chase. The pain trade in this setup is higher, not lower. Most institutional desks are still positioned defensively or have cash to deploy. So any clarity from the Iran process unlocks that cash. Now, where do we actually get paid if the Iran story resolves? Not in the US, except maybe the AI trade that is going up no matter what anyway. The US is a marginal beneficiary of the Iran situation. You need to look at the countries that struggle with expensive energy. So, Europe, the UK, and Asia. In terms of sectors, those that are heavily dependent on cheap energy inputs will benefit massively from the resolution. So, for example, industrials, mining, manufacturing, and so on. Now, the wider lens, because Iran is one piece of a bigger story, in my opinion. Let's talk about the outlook for the rest of 2026. The single thesis I would build the rest of 2026 around is this: the dollar should weaken further, materially, between now and the midterms. And most of what happens in asset markets depends on that move. The reason starts with politics, in my view. The administration has two visible problems it needs to solve before the November 3rd midterms. The first one is keeping asset prices grinding higher. The second one is bringing the long end of the yield curve and with it mortgage rates back into the affordable zone. Both of these are solvable with a weaker dollar. Take each one in turn. The equity side is straightforward. The president loves praising a high stock market whenever he has an opportunity. The perception is that elections are easier to win when the market is going up. Also, the AI capex cycle has become a meaningful piece of US nominal GDP. The annualized run rate is somewhere between $600 and $700 billion, which is roughly 2% of GDP. And it is going to accelerate in 2027 toward $1 trillion. The economy needs properly functioning markets to fund all that infrastructure spend, which has become the main driver of growth. Then the mortgage side is, in my view, the bigger political pressure point. The 30-year mortgage rate in the US is sitting at 6.5%, which is lower than the peak of 7.8% in October 2023, but still relatively high. For a typical American family, those mortgage rates make the median home unaffordable in most major regions. Housing affordability is a real issue going into the midterms. Every voter who has tried to buy a house feels it. The administration cannot fix this issue with the Fed directly. The Fed sets the short rates. The long end is set by the market. So the only way to pull mortgage rates lower is to engineer a structural buyer to step in and buy long end bonds. And a weaker dollar helps with that too. A weaker dollar does two distinct jobs at the same time. And that is why it is such a clean lever. The first job is the mechanical one. Most global assets are priced in dollars. Equities, commodities, everything. When the dollar weakens, the dollar price value of those assets goes up, just by definition. So a weaker dollar puts an automatic tailwind under the equity market. That solves problem one. The second job is the foreign duration bid. This is the more important effect for rates. The Japanese life insurance complex sits on roughly $4 trillion of assets and has a structural mandate to hold global long-term bonds alongside Japanese government bonds. The Chinese reserve complex sits on a similar scale. Both of them have been net sellers, or at best non-buyers of US Treasuries for years now, because the dollar has been relatively strong and the FX hedge cost of holding a 10-year Treasury has been killing the trade. Once you hedge the dollar, the yield in yen terms or yuan terms is unattractive. Now, flip it the other way. When the dollar weakens, a US Treasury is worth more when you convert it back into yen or yuan. The trade pays again. The buyers come back. The long end caps. Mortgage rates start easing, or at least stop rising. That solves problem two. So, one mechanism, two jobs. How does this actually play out? The sequence matters. The first mover should be Japan. The Bank of Japan has been normalizing policy since they ended yield curve control in March 2024. The policy rate is at 0.75% today. What I expect over the second half of this year is that the Bank of Japan accelerates that normalization. They hike faster than the market currently expects, or at least signal that. As Japanese short rates rise, the FX hedge cost narrows and buying US Treasuries becomes more attractive. The yen appreciates against the dollar. USDJPY is currently at 159 and should head toward the 140 level. That is a 10 to 15% move in the dollar against the yen. It should not happen overnight, not in one quarter, but possibly by the end of the year and into next year. And I think this has all been discussed recently when the Treasury Secretary traveled to Korea, Japan, and China. He met with the Bank of Japan governor and the finance ministry. We do not know the details of those meetings, but I doubt they talked about Japan buying American rice, as the headlines want us to believe. So I think it will be choreographed. Then comes China. The Trump-Xi summit in Beijing in May 2026 was officially about soybeans and Boeing aircrafts. 2 days of state-level meetings, and the headline was about China buying $17 billion per year of US agricultural purchases through 2028 and 200 Boeing aircraft. The Treasury Secretary spent 3 hours in Korea with his Chinese counterpart before the state visit began. I find it hard to believe that the substance of the largest US-China summit since 2017 was about that. I think it was about the FX coordination underneath. Chinese yuan has already been weakening after the trade war began last year, and that trend should continue. China benefits from that move. The large stock of dollar-denominated debt sitting on Chinese property developers becomes materially easier to refinance, which takes pressure off their domestic property problem. On top of the Bank of Japan and the China channels, we get two reinforcing tailwinds. The first is the iron resolution we just walked through. When the energy shock fades, inflation pressure eases, the Fed gets cover to ease, and the dollar weakens through that channel. So iron resolution is important too. The second is fiscal. It would be naive to assume that the current administration will not try to buy votes before the midterms. Stimulus are coming. and soon, because we're already in late May. The administration has been signaling some form of consumer stimulus since November 2025, when the original $2,000 tariff dividend check was floated by Trump. I guess now it will not be called a tariff dividend, since there is almost no tariff revenue anymore. They will call it something else. So, fiscal expansion before midterms is dollar negative on the margin, and the administration has every incentive to push it. What does this mean for US rates? My view is that the 10-year, currently at 4.5%, has either peaked already or is very close to peaking. There may be one more attempt higher, driven by the June and July CPI prints, which will be contaminated by the Hormuz energy pass-through and will look ugly on the headline. If that attempt comes, it should fail and roll over. The mechanism is exactly the one we just walked through. As the dollar weakens against the yen and the yuan, the foreign bid returns at the long end, and that caps the move. How does the timing play out here? My base case is that the next 2 months are noisy. Late June, July, possibly into August, we get sideways or digestion as the inflation prints come in hot from Hormuz contamination and the market processes the Bank of Japan accelerating. From August into Q4, the trade picks up materially. All the pieces come together and the market is marching higher into midterms. Okay, to close this out, the Iran conflict is closer to resolution than the headlines admit. Even if the deal slips, the energy market is balanced anyway through the next 7 to 8 weeks. The relief trade lives outside the US, in Europe, the UK, and Asia, and in the sectors most exposed to expensive energy. Volatility around the headlines is still a buying opportunity. Then, the outlook for the rest of 2026 sits on one thesis: a weaker dollar. That single move does two jobs at once. It lifts the equity markets mechanically, and it brings the foreign duration bid back to the long end of the US Treasury curve. That caps the 10-year, which in turn caps mortgage rates, which solves the affordability problem the administration needs to fix before November 3rd. The path runs through Japan first, then China. Iran resolving is part of the same trade. Fiscal stimulus headlines reinforce it. Alright, that's it for today, guys. If you got something out of this, found it useful, hit subscribe and like, and I see you next week.